Hi, everyone. I'm Mike Pacito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. It's been a strong quarter for the strategy, but not necessarily for all the reasons investors may intuitively think. We'll be diving into this alongside some other points of color along the way over the course of this 10-minute update. But before I hand it off to Andrew for his commentary, we'd like to encourage you here to let us know if you have any questions or topics you'd like us to discuss in upcoming videos. We talk to a lot of advisors, allocators, and investment professionals about a lot of topics as we're out and about speaking about the DBMF strategy and the managed futures hedge fund space at large. And we'd love to discuss the things you'd like to talk about for benefit of everyone who watches and listens to these updates. So if you have anything you'd like us to cover, please drop us a line via email or however you'd like to get in touch with us, and we'll look to incorporate that into future updates. Okay, with that, Andrew, please go ahead and take the wheel.
Thank you, Mike. And as always, thanks to everyone for listening in. So in the interest of trying to make these presentations as user-friendly as possible, I decided to try to boil down the first quarter into 3 talking points. So here they are. First, after the sharp shift in markets late last year, we pivoted into risk-on mode early in the first quarter. This drove gains, and we ended up around 12% net. And as we'll show in a few slides, more than 200 basis points ahead of the SocGen CTA index, here and after the hedge fund index, and over 300 basis points ahead of the Morningstar US Trend Systematic category, here and after the Morningstar category. So for context, the S&P 500 was up around 11%, but the Bloomberg Ag was down slightly. Second, on the macro front, good economic news once again became good news for equities. When it became clear that the shock Fed hike cycle was over and that the economy is likely to avoid a recession, and that we sidestepped various macroeconomic landmines, et cetera, managed futures funds jettisoned their bearish positioning and pivoted to risk on. Lastly, and as a result of this, we saw gains from rising equity markets, but also currencies and commodities. The overriding point, as we talked about a few months ago, is that managed futures funds will hunt for new opportunities when it's clear the world has changed. And we followed along, albeit arguably in a more efficient format. Now let's drill a little bit deeper. Next slide, please. Here's our regular chart on stocks, bonds, and DBMF. Since inception nearly 5 years ago, DBMF has returned 9.4% per annum with a negative correlation to both stocks and bonds and over 1,000 basis points of annualized alpha to equities. To add a little color to the narrative above, here's something I like about this chart. If you scan the chart and focus on 2022 and 2023, it's obvious that we were in crash protection mode. Generally, when equities went down, we'd go up and vice versa. But in 2023, the tides began to shift, and you can see periods where we were rising with equities, with the exception of the nasty reversal in rates late last year. However, by the beginning of this year, we're out of crash protection mode and making money from various risk-on trades, which we'll discuss more in a few minutes. In this context, an interesting question to ask. After 2022 and in late 2023, how many allocators would have expected managed futures to slightly outperform the S&P in a great quarter for the S&P? It's a lesson in one of the key strengths of the strategy, the dispassionate hunt for opportunities in both bad markets and good. For me personally, I've learned to get comfortable with what can feel a bit like a leap of faith, that the money-making opportunities next year or even next quarter or month will often be very different from those today. And I have an example of this coming up. Next slide, please. Here's a scorecard on first quarter performance. You may recall this format from earlier updates where we talked about seas of red and green over the past few years. On the left are DBMF, both price and NAV, with the SocGen CTA index and Morningstar category. This was one of those quarters where we comfortably outperformed both, despite the hysterical applause you may have heard about the cocoa markets and some other non-core trades that have been working very well. Equities were up across the board while bonds were flat to down, a big shift from 2022 and 2023 when they all moved in tandem. It was also a good quarter for commodities and a decent one for liquid alts. Next slide, please. So here's our slide on volatility-adjusted positioning. I've moved it up because it really underscores the point I've been making about adaptive dynamism. The green bars are current positions and the red dots are from year-end. Basically, starting from the left, in 3 months, we've gone from flat positioning in commodities to large longs in both crude and gold. With the return of the king dollar trade, we've dialed up shorts in both the euro and the yen. We don't show much conviction in bonds after the insane whipsaws over the last year. And we've pivoted from a flattish equity book with a spread trade of US over EM to a heavily long book concentrated in non-US developed markets, e.g. Japan. If you go back a few months ago, we talked about how it felt like the portfolio was in transition. And today there's strong conviction in 3 of the 4 major asset classes, which brings us to the next slide. So here's the contribution by factor in the first quarter. And if you look at the right, you can see that more than half of gains were driven by equity markets. The S&P earlier in the year, then EFA as that position was dialed up. But the big surprise is that the single most profitable position has been the short in the yen. CTAs seem to hold this position as the currencies broke to new lows. Remember also that the yen was the biggest moneymaker in 2022. And lastly, you'll see that crude oil and gold have positive contributions, a relatively recent and promising development. So 2 points to underscore. First, while I consider us risk on today, it's not all about equities. In fact, our beta to the S&P in the first quarter was only around 0.5, which means a bit more than half of performance came from other sources. Second, it's impossible to know which asset class will drive returns going forward, so I think it's better to remain flexible and exposed to all of commodities, rates, and equities. So an amusing story on this front. In 2021, a sophisticated allocator friend saw that we hadn't made money in currencies in years and asked why we didn't just simply eliminate this asset class. After watching how the yen trade was a key driver of performance in 2022, we basically said, that's why. And late last year, we were talking about how frustrating the whipsaws had been in equities in both 2022 and 2023. So I said, and guess which one will probably work the best in 2024? And we both said half jokingly, equities. So the big story here is that it is not about one quarter or one pivot, but rather the strategy is built to do this regularly over time. Who knows what the great trade will be in 2026? So for long-term allocators, my point is that this approach, a nimble, opportunistic macro strategy, has the potential to be a valuable complement over time to model portfolios that are, by design, strategic and hence slow-moving. Diversification is about embracing different sources of return, and we clearly think managed futures has a role in every multi-asset portfolio. So hopefully you can help us spread the word. And with that mini sermon behind me, I'll hand the baton back to Mike.
Thanks, Andrew. So let's wrap here as we often do with our long-term performance comps. With this solid quarter behind us, DBMF has expanded its outperformance against its 2 key benchmarks, now ahead of the SocGen CTA index by over 180 basis points annualized, and ahead of the Morningstar systematic trend average by over 380 basis points annualized. Beyond DBMF's outperformance against those benchmarks, we believe the managed futures asset class deserves serious consideration for diversified portfolios, and along those lines should be a strategic allocation. To paraphrase Andrew here, our goal with DBMF is both to refine the managed futures space with a more efficient, consistent solution, and to expand utilization of managed futures overall by investors. So with that, thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out. Just send us an email at team@imgpfunds.com.